It's official. With 97% certainty, the likelihood of us getting interest rate cuts this week from one of the major economic contenders in the world is almost guaranteed. The European Central Bank on June 6th, in just 2 days from the filming of this video, is expected to conduct its first interest rate cut of the cycle. And this has some broad implications for the United States. But first, don't take it from me, take it from Barclays. Barclays tells us the ECB is expected to cut with a 97% market implied probability on June 6th. And this is consistent with the same outlook that looks for 2 additional cuts later this year, September and December. Now, what does this mean for the United States? And what does this mean for what could be a good potential investment? Well, let's talk about that. And Barclays also talks about what the good investment could be. But first, practically, this means the European Central Bank will essentially be leading the Federal Reserve. And I'm not convinced that the Federal Reserve likes to be led. It seems like the Federal Reserve prefers to be the leader in all things interest rates. But in this case, the United States has just had higher for longer inflation, unlike the European Central Bank, which generally uses a harmonized measure of inflation. We talked about this a few weeks ago, where Deutsche Bank actually argues that the harmonized index of consumer prices, they call it the HICP, is a much more accurate way of measuring inflation. And that's why European inflation looks lower than in the United States, even though Europe also has some level of stickier inflation in services. And in this video, I'm going to actually show you how sticky inflation might actually be very normal. We'll go into history and look at that. But consider that Deutsche Bank tells us that if you apply the European standard of inflation to the United States, we've actually already been at 2% inflation for 9 months since the middle of 2023. So, what does it effectively mean when the European Central Bank starts cutting rates and we're still at peak rates, especially since the Fed keeps slamming the door shut to the idea of raising rates again? Well, it effectively lowers yields in the United States as well, which could be good for US stocks. Think about how that could work mechanically. If bond rates go down in the European markets, either in anticipation of cuts or because of cuts, then what happens is European bonds become less desirable. So their pricing for bonds can go down slightly as demand for those goes down, which ironically actually boosts yields a little bit. But in the US, we still have higher yields, so demand could go up for our bonds, driving up pricing for our bonds, which actually lowers rates. See, the market has this really funny way of practically trying to equalize what's going on across the world, of course, adjusted for the reality of inflation in various different areas. You're not going to have the same rate, of course, in Argentina as you will, or in Europe or the United States, because they actually have substantially higher inflation. Now, of course, you've got Chainsaw Javier Milei, who's working on that, but it's going to take a little bit of time. And time is something we're going to be talking about in this video, because when you look at this history, you're going to be realizing, what's happening today might actually not be different at all. It might be totally normal. But think about what that means for a moment. The ECB cutting rates should actually slightly lower yields in the United States as well, which should be bullish for the Nike swoosh recovery. Consider for a moment that the 10-year Treasury, right now at least, is sitting at a 1-month low. Now, that's not really highly impressive given that we're still sitting at like 4.38 on the 10-year, but it does show that we're finally topping out on interest rates, which is nice. You could see that here on screen. We're at a 1 month low on the 10-year, and we're at just a negative 42 basis point 210 inversion, which does still portend a recession potentially coming, but it is indicative of rates trending down, which is good. Right now in the United States, we are pricing in 1.7 rate cuts for December of 2024 and one rate cut being priced in for November of 2024 right after the election. Yes, that's after the election. So a lot of folks are going to look at that and go, oh, of course it's right after the election. It's politically rigged. And frankly, it might be. After all, Donald Trump has made it very clear that Jerome Powell will be fired. So let's just say Donald Trump is not doing himself any favors with the Federal Reserve. And if there's a political bias, then Donald Trump ain't helping himself. But Donald Trump does this because it's very easy to villainize the Fed. After all, they're the ones who hiked rates to these levels. They're the ones who have made cars more expensive, credit cards more expensive, housing more expensive, student loan debt more expensive. So of course it's a populist argument to say, hey, look, he's the guy who made rates go up. Don't mind what fiscal authorities had to do with it. That includes President Donald Trump and President Joe Biden. He's the guy who actually pulled the lever. So it's easy to villainize the Fed. It's certainly not going to help, though, that the November Fed meeting is literally right after the election. They actually, I think it was supposed to be on the day of the election, and then they delayed it to the next day to not have the Fed meeting on the same day as the election. Whatever. So, what did I find out about history, and what is a potential investment strategy going into rates beginning to decline? All right, let's hit both of those. Quick reminder, this video is brought to you by a paid promotion with Coinbase. If you now go to metkevin.com/Coinbase, you could get up to $200 just for getting started with Coinbase. So check out Coinbase if you're interested in trading crypto or creating a crypto account. Just go to metkevin.com/Coinbase to learn more and learn how to sign up for this crypto brokerage. Now, let's talk about, and that's a paid promotion, let's be clear about that. But now, let's talk about where to invest and what history has told us. So, history has told us that inflation takes a really long time to come down. Take a look at this. Here's the multivariate core trend of inflation. You see this little tick right here for January 2023 where my mouse is where my mouse is right here? That's actually the end of 2023. So this little bump right here was January of 2024. And you could see that inflation had a little bump at the end of 2023 and at the beginning of 2024. And multivariate core is trending down. Great. Now, what I wanted to do is find out, is this bumpiness normal? And what I found is that if you look at the 40 years of disinflation that we had from the early 1980s to about 2020, what you'll notice is that it's actually extremely common for inflation to be very, very bumpy. Look over here on the left side, just this left 20% for a moment, very, very bumpy over here. Look at the right half of the screen. It's all bumpy. Obviously, here's a recession, but it's all very, very bumpy. The only time you really didn't have a lot of bumpiness was over here between the beginning of 1990 and 1999. In fact, between March over here, where we sat around 4.3% multivariate core inflation, to over here, where we sat at just 1.1%, it took 9 years. So even when inflation was not bumpy, it took 9 years to get inflation down. Now, right now, multivariate core sits about 2.9-ish%. So to line that up with here, we'd be about halfway down this 1990s curve. But even if we had this same rapid decline over here, if we just pick up from that midway point to the low, it would still take an extra 5 years to get inflation as low as it was at the end of the 90s. And so what that shouted to me was, patience is a seriously undervalued virtue. Honestly, I have been a victim of this myself. After the Nike swoosh, Larry Kudlow V-shaped recovery, I thought markets were supposed to move really fast, and I thought that inflation would rapidly come down. But history tells you that's wrong. History tells you that inflation actually takes quite a while to come down. I personally do think, and I know this is an unpopular opinion, but I personally do think over the next 10 years, we are going to see inflation go lower than where it's ever been before. But I never realized that the real start to inflation coming down would take so much longer. And so that patience is something I have to bake into my investment portfolio. And one way I do that is by making sure I don't go all in on the interest rate sensitive sectors just yet. Instead, I have a nice diversified portfolio that will enable, quite frankly, patience. And so that's exactly what I'm doing. I'm exposing myself to an actively managed ETF that has a good, diversified basket that I think will work even as we have patience going into slowly declining inflation. Now, what does Barclays suggest as a potential investment opportunity? Well, Barclays, in their piece on screen right here, suggests that there is a real potential in small caps. See, they say, we believe lagging small caps, which typically display higher interest rate sensitivity, have yet to price in much of the interest rate relief. And what's fascinating is if I go to the passively managed IWM, which is a Russell 2000 small cap ETF, I see on Webull that it's been basically range bound for 3 years. In fact, if you go from this right side here, 3 years back, you're here. It's kind of remarkable. You've done nothing for 3 years. And so I think there's a chance that if Barclays is right, which is calling for rate cuts in September and December at the ECB after this June 6th rate cut, and we'll see what communication we get from the ECB on June 6th. But they argue basically that small caps could end up seeing a Nike swoosh recovery as well as what we saw in the S&P 500 and the NASDAQ, which I expect will continue. Now, remember, smaller cap companies, they're what I call interest rate takers. So when interest rates are high, they pay the higher rates. Whereas mega cap companies, which are cash rich, are interest rate, how should I say it? Let's rephrase this, okay? So small caps, they are interest rate payers. I shouldn't say takers. They're interest rate payers. Small caps pay the higher rates because they have to. They have to borrow to survive. Cash-rich mega caps, they're more like the interest rate takers. They're the ones who take the higher interest rates because they have so much extra cash. So really, in a high interest rate environment, what you're really doing is just making the rich richer again, which is really frustrating. But unfortunately, it's the way our capitalistic markets work. Now, I'm not arguing that that's the best system that exists. I think there are debates to be had. But the point is, it's the system that we're part of. And so when Nick T from the Wall Street Journal tells us, hey, look, housing, very slow to decline. Core services, very slow to decline. Core goods, kind of back to normal, but these segments are going to take time. He's kind of reiterating what we're talking about in this video. Patience is going to be the key. Maybe a balanced portfolio that also has some exposure to small caps, though, could do really well. So it's going to be something that I'm paying attention to. I find it very interesting. And I'm personally tempted to get some exposure to IWM. We'll see what happens, but it's something I'm going to be paying attention to, especially as the ECB strikes its first rate cut. So remember to go to metkevin.com/Coinbase. Thank you so much for watching. Check out the courses on building your wealth at meetkevin.com, and we'll see you in the next one. Thanks. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.